Okay, welcome everyone. Today's webinar is titled Using Volume to Gauge Supply and Demand. This is your 2-minute warning. We'll get started shortly. Okay, so let's get started here again. Today's webinar, Using Volume to Gauge Supply and Demand. I'm going to be your host. My name is Andrew Rocco. I'm an education coach here on the MarketSmith team. And let's just go over our objectives real quick. Number one, we're going to learn how volume reflects supply and demand. So as investors, the main thing we're trying to gauge is supply and demand. We're using KenSlim to help us find, the leading stocks in leading industry groups. But at the end of the day, it really just comes down to price and volume action. So what I found is, price and volume is going to be paramount to everything else, price specifically, because only price is going to pay. But volume will really give us good clues about how sustainable that price action is, both up and down. We're going to cover examples of high volume breakouts as well as sell-offs. So again, selling is just as important as buying. As far as buying, we want to time those breakouts properly. And the volume is really just going to increase our odds. I found that the volume definitely increases those odds on breakouts, especially when we're in a choppy market environment. Having that volume kick really gives us a little bit more conviction. And then on sell-offs, you can pick the best stock, but if you sell it wrong and you're not paying attention to those price and volume clues, it's going to be of no use. So you really want to pay attention to that, and we'll go through that. And then we're going to highlight some of the most popular and some of my favorite volume screens here in MarketSmith. So before getting into things, just check out the webinar panel in the upper right corner of your screen. If you have any questions, feel free to type them in, and I'll try and get to as many as possible, either during the presentation or afterward. And you can see your question box is right there. Okay, so this is one of my favorite quotes from O'Neill's book, How to Make Money in Stocks. And it says, the price of almost everything in your daily life is determined by the law of supply and demand. What you pay for your lettuce, tomatoes, eggs, and beef depends on how much of each is available and how many people want these items. So, I'm living out here in Los Angeles. I've seen rent go through the roof, and just like anything else, it's a function of supply and demand. Produce at the supermarket, again, the prices of that have gone up over the years. And a recent example is I have a buddy who actually flew out to LA to evacuate Hurricane Irma down in Florida. So He was telling me when he was trying to get a flight, it started at $200. He hesitated. And as more people panicked, and as that hurricane, the category went from category 3 up to 4 and up to 5, the supply of those airline seats decreased and the demand increased. So with the stock market, it's the exact same thing. These institutions are gravitating towards stocks with liquidity, stocks with growth, earnings growth, revenue growth, top industry groups, and they're going to, look to accumulate shares of those stocks. And remember, the institutions, it's not like they can go on their online broker like we can as retail investors and just type in, buy 100 shares of XYZ. They're buying thousands and thousands and many times millions of shares. So it's something that's going to take place over time. And again, one of the benefits of using MarketSmith and being a retail investor is you can see those footprints in the chart. There's no way of hiding those big footprints. If you're a David Tepper, a Stanley Druckenmiller, Warren Buffett, those footprints show up in the charts. And as retail investors, we're able to piggyback on those institutional investors who really know the story of these companies inside and out. They know the balance sheet. They know, they have a pretty solid idea of, what the next earnings report is going to look like, and they have an entire analyst team. So we don't have those advantages, but we do have the advantages of being a little bit more nimble and able to view that price and volume action. Okay, so we're just going to go through a quick example. I think Arusha used this in the last one. It's a candy bar example. If there was 5 people waiting online, the price is not going, or I'm sorry, the demand and the price is not going to be as much. So obviously it's not going to be a problem. But if there's 5,000 people online, for example, this guy right here, his place in line is going to be in demand. So, someone in the back of that line of 5,000 people, which is obviously a little unrealistic, but they would be willing to probably pay that guy for his spot in line. Okay, so again, same thing that happens in business outside of the stock market goes on with the stock market. So how to gauge supply and demand using MarketSmith. So what we use here in MarketSmith, and I think it's a pretty good gauge because it's going to use the primary trend, is the 50-day moving average for volume. So that's that red line that you see on the volume table down below. So if you're seeing volume that is above that red line, it's telling you volume is tracking abnormally high. And if you're seeing volume below that red line, it's tracking abnormally low. So, as a general rule, on up days, we like to see high volume. On down days, we like to see volume dry up. Now, don't get too caught in this. Remember, there's no such thing as a perfect stock or a perfect market. So don't expect your stock. I get a lot of questions on this, but don't expect your stock every day to go up on high volume and every day to, dry up on low volume. You'll miss every winner that way. So we're trying to kind of just look at it overall. Does it look like there's more buying pressure or more selling pressure? Remember, there's not actually ever more buyers or more sellers in the market. What's happening is shares are trading hands. So it just means there's more buying pressure on those up days or more selling pressure. But it's never, more shares bought or more shares sold. It's just the pressure of that volume. Okay. Let's see here. Yeah, so I got a question from Rick asking about dark pools. Do dark pool trades show up in MarketSmith and high frequency trades show up in MarketSmith? So I'm just going to answer this question real quick. Yeah, so any volume coming up into the stock will show up in MarketSmith. Keep in mind our volume is a little bit delayed, but we do compensate for that by projecting the volume out. So, in order to get the projection of the volume, you're just going to left click on a price bar and you'll see a yellow data box will appear. And I think I have it in one of the slides coming up. But in that yellow data box, it's going to show you at what percentage the volume is tracking. So, if it trades, let's say 100,000 shares on average, the 50-day average is 100,000 shares. If it trades 100,000 shares in the first 30 minutes after the open, that volume percent change, is going to be a few thousand%. And let's say that stock is breaking out. That's exactly what we want to see. But, long story short, Rick, yes, any volume that comes into your stock will show up there. Another thing I want to mention regarding the high frequency trades, this is all over the news. How they're scamming people in the market, which is fair enough on a very, very short term basis. The high frequency trading probably takes a penny or two, maybe sometimes a little more during your trade. They're basically just scalping in front of you. So they're making a few pennies off you. So the way to beat those high frequency traders, in my opinion, is to be a low frequency trader. So I know that William O'Neill, he never dabbled, it didn't matter 20, 25 cents, 50 cents did not make a difference to him. But because we're trying to follow this primary trend, we're trying to stay in stocks that are above the 50-day moving average. So went on a little bit of a tangent there, but again, the way you beat those high frequency traders is just be patient and be a low frequency trader. Okay. Moving on to this next slide here, I'm talking about institutions. So the institutions, again, like I mentioned before, they're responsible for the majority of the volume in the market. Somewhere between 70 to 80% of the overall market is due to these institutions, pension funds, hedge funds, mutual funds. So they're really going to be the ones who are dictating the price action in these stocks. They're going to be finding the best companies and putting money to work. It's our job to identify, it's our job to identify that volume coming in and take advantage of it. Okay, but again, those footprints are going to show up. And what we like to call it in-house here is skyscrapers of accumulation. So a skyscraper of accumulation is basically a large blue bar that is significantly over that red line, that 50-day moving average line. So a large blue bar is what those institutions are going to show up like on our charts. And it's like an elephant, getting into a bathtub. Again, they cannot hide it. I just want to emphasize that. And that's really our advantage in using a tool like MarketSmith. Okay, so let's go through a few examples here. We're going to look at some stocks, and we're not going to show the names because it's not so important that we know the names of the company. We've studied some of the biggest winners going back to the late 1800s, and really the concepts of price and volume remain the same. The only thing that is really changing is the names of the company. So, in Kenslam, we know we're going to be looking for innovative companies. We know we're looking for massive earnings, massive sales, leading industry group. We want the market direction in our favor. So none of that changes. It's just going to be the different stock names. So, at one point it was the railroads in the early 1900s, late 90s, it was the internet stocks. This year it's been some of the semiconductors. So we're trying to be in the leading stocks of the day. But like I mentioned, as far as price and volume concepts, nothing changes. Huge demand is huge demand any way you spin it. So here's a great example of a stock that is showing massive accumulation. And I wrote institutions right here because you can see these skyscrapers of accumulation. You can see for this stock, it generally, and this is a weekly chart, generally on a weekly basis, it looks like this stock trades about 6 million shares per day. You can see on some of these massive volume bars, this one, I'm sorry, 6 million per week. This one's 18 million for the week on this bar. Here it looks like it's close to 11 million. And then this one looks like it's closer to 20 million. Notice it's not perfect. Not every down week is on lower volume, but these are the kind of patterns you want to see. Really pay attention for when there's massive volume, which way is it going? This one has those skyscrapers of accumulation. Okay, Yassine, good question here. Is it wiser to study volume on a weekly time frame than daily? Suppose we see low volume breakout on a daily, but on the weekly, we know there's institutional interest with volume, which we track. Does it make any difference? So that's a great question. I don't really have, a perfect answer for you. So the market, a lot of it is cut and dry. We're looking for those massive earnings, massive sales. Again, top institution. Generally, on a breakout, we're looking for volume to be minimum 40% or more on that breakout day. However, I do recommend looking at both the daily and the weekly. But for timing purposes, you're probably going to want to use that daily. And like I said, as per Bill's book, Bill likes to see a minimum of 40% or more. For me personally, I found that the odds go much higher in my favor. There's better risk reward when I see a few 100% or even a few 1,000% on those breakouts. So sometimes it might be earnings related, it might be an analyst upgrade, or sometimes it just might be a standard breakout with massive accumulation, which is my favorite. But yeah, so I would say look at both for timing purposes daily to get an idea of the primary volume, the primary trend, use the weekly. So the answer is look at both of them and gauge it to the best of your ability. There's parts of investing that are science, parts of it are art. That's more along the art end of things. Gary says we should use the name of stocks. Gary, unfortunately, we run money here in-house. So for compliance purposes, we're not able to show the specific names of the stocks. So for the most part, so I do apologize for that. But again, it's not as important. The concepts are more important. And if you do want individual stocks, always refer to William O'Neill's book. He's got a few hundred examples in there. And on the Stay in Step with the Stay in Step webinar, we do go over individual stocks from time to time as well. So there's plenty of places to find examples. Alan asks, do the volume spikes happen at certain times? Earnings, reports, end of a trend? Yeah, Alan, it could really happen anytime. After earnings, there's almost always a volume spike. Pullbacks to a moving average, sometimes when it gets support, a lot of earnings will come in, big reversals, analysts, company news, yeah, almost anything. But the point is we're trying to not pay too much attention to the news and really see the reaction. In fact, I had a stock today that had bad news come out on it, but the price and volume was showing me that the institutions did not care. The stock was moving up, it broke out, volume was increasing. So that's actually extra bullish in my opinion because it brushed off that bad news. And it's a really good tell. If bad news comes out, your stock goes up and volume increases. So I'm just going to move on to the next slide here. I tend to go off on tangents a little bit, but I will get to some more questions in a little bit. Okay, so here is an example of a cup with handle breakout. You can see pretty much a perfect cup with handle here. Now, a few things I want you to notice. The main area we want to pay attention to volume is on that breakout day, like I mentioned. However, we're also looking for volume clues in the base structure. So, for example, this base, you can see it traded massive volume on this right-hand side. So you see a gap up, massive volume comes in. Does it mean we're going to buy the stock there? Not necessarily, no. But that tells us that there's accumulation in the base. We're still going to wait for that proper area. We want to wait for the best risk reward, but along the way, we're stalking these stocks. We're looking at that price and volume action. We're looking for these footprints, any signs of accumulation in the stock. You can see this stock, it had a little shakeout here, which is kind of good to see. It undercuts, by shakeout, I mean it undercuts this area on the left side of this cup. And then gaps up. It looks like it might have been an earnings report because the volume was just massive. It digests in a perfect cup with handle. And then on that breakout day, that is exactly what you want to see. Massive volume. And notice how the relative strength line is confirming, as well as the price finishes at the top of that range. So this is just picture perfect. And this stock, happened to go on a massive run after this. Volume tracking 125% above average. Again, the minimum is 40%, but you really have to, ChenSlim, it's meant to give you that framework, and then through your own personal post-analysis, you're going to learn more what works for you. So for example, for me, I tend to have more success in stocks with liquidity. Stocks where when it breaks out, the volume is coming in a few 100% rather than just the 40%. Stocks within top industry groups. So, use ChenSlim as a framework, but if you notice something, gives you better risk reward, by all means, put that into action. Bill will tell you he'd rather have 125% volume come in on that breakout rather than 40%. But he wanted to just lay out that framework to give new investors, a chance to have a solid start in investing. So that's where he did a good job. But of course, the more accumulation, the better. Supply and demand. We're looking for supply and demand all over the chart. But especially where it breaks out. That is the critical area. When it enters that blue zone, if you use the pattern recognition on MarketSmith, that blue zone is that pivot zone. That is the critical point where we want to see volume, although we are looking at the overall chart for volume clues. Scott asks, do you typically use log or arithmetic scale when looking at volume? I use the arithmetic. I just prefer, my eye is trained that way on the daily chart. And then I think the weekly is log. So whatever way you feel comfortable, I'd say in-house here it's mixed. I think more people probably use log, actually. I think I'm one of the few who use arithmetic. But it is mixed. There's no, right or wrong answer. Either way, you're looking for that accumulation to come in, and it's still going to show up either way. So there's, I wouldn't worry about that too much. Again, the main thing is that breakout day, that critical point. We want to see massive volume come in. Matt asked another good question from Matt here. So if all other conditions are prevalent in a security, meaning all the conditions of Ken Slim are met except for volume, are there any conditions that you would just justify buying it? So I would say, as a model, you want to see that volume come in. I would be lying if I told you that, any time that I've bought a stock, the volume was coming in. If I really want to own a stock, I know that story, the chart pattern's just perfect, I'm going to buy that stock. Sometimes what you'll find is volume's going to come in later. So again, we don't want to fall into perfect stock syndrome, but we're trying to use all these clues in our favor. But again, Matt, I would be lying if I told you every stock that I buy, there's massive volume coming in on that breakout. But I'd say 8 times out of 10, that volume is present. Okay, let's see what else we got here. Lisa asks, if you were watching this stock, would you have put in an order to buy prior to the breakout, or are you watching for the breakout, then wait till the next day to see what happens? So, Lisa, I generally purchase stocks as they're crossing that pivot. That's really your best risk reward. Sometimes you can find an advanced entry to get into the stock a little bit earlier, which we're actually going to have a webinar with one of our senior portfolio managers next week going over aggressive entries. But all in all, you want to see it cross into that blue zone and preferably volume coming in as it's doing it. I know Bill O'Neill, he pretty much purchased all of his stocks at standard pivot points. So I would say don't get too cute with that. But yeah, generally you want to see it cross into that blue zone and you want to see that heavy volume come in. Don says, you emphasize liquidity. What is your minimum liquidity requirement? So generally, he's asking dollar value. Generally, I trade stocks, over $100 with 500,000 volume or more per day. So 500,000 shares or more. It's not a hard rule that I have, but through my post analysis, and I really recommend doing post analysis, it's going to be the best way, to learn from yourself. I like to look for 500,000 shares or more traded per day. Some guys in here do great with the small caps, but I just find that the stocks with liquidity, if bad news comes out, they're going to be able to absorb that bad news a little bit better. And it's just going to be a little bit of a smoother ride as far as that goes. Also, institutions are looking for liquidity. Stanley Druckenmiller is not going to be able to purchase stock that trades 50,000 shares per day. He needs to be able to sink his teeth into that. He needs a few million shares traded per day. So I'm trying to be where the institutions are because I know that the institutions are the smart money. Okay, let's go over some examples of high volume breakouts here. Okay, so you see this stock here has a nice run. So you get that 30% move you want to see into a base structure. It attempts to break out, but notice how no volume is present here. So this kind of goes back to one of the earlier questions. Do you always wait for volume? Not all the time, but you can see your odds are drastically increased when that volume comes in. So I would say only take a breakout without volume if you really have conviction in the company. You manage your risk, keep that stop tight. But all other times, we generally want to see that massive volume come in. And you can see, again, skyscraper of accumulation. You had a big volume breakout out of this double bottom base back here. And then this cup with handle, it breaks out on low volume, fails, and then breaks out again. And this will happen from time to time. This is why O'Neill, one of his rules was always, if I get shaken out of something, I must get back into it if it comes back through that pivot. So this stock is a great example. He might have not bought it because the volume didn't come in, but if he did and he got stopped out, that's 7 to 8%, he's re-entering this stock as it shows that power. And this looks like it could have been earnings driven as there was massive volume, but it's not always the case. But either way, we're just gauging that price and volume action, and we're taking action as it crosses that pivot point. Again, I'm pointing out that original breakout out of that double bottom base. Picture perfect right here. As you can see, there was actually a big red bar a few weeks prior, but notice how it shows support. So it was still a red week, but it closed at the top of that red week. So that, in my opinion, that shows support, and then you get your massive breakouts. Okay, and you can see here's what happened afterward. So these breakouts, sometimes they're going to digest. So you want to be patient. So this stock, you probably got off to a fast start. You're probably up 5 or 10% if you're buying the standard pivot. And then it just, does nothing for 5 or 6 weeks, which is fine. We're looking for it to hold above that 10-week. You could see almost to the penny, it gets support at that 10-week moving average. And then it goes on a nice run and it just rides that 10-week. This is exactly what we're going to do. Not all stocks are going to work like this. Some of them will just fail out of a base like this, but that's why we're managing our risk. We're cutting those losers short and we're running those winners. Here's another great example. You can see this stock has multiple volume clues. Again, you get that volume punch within the base. So we're not looking to buy there. We're just taking note of it. Yes, there's accumulation in the stock. Yes, institutions are interested. And then picture perfect here. You get a nice shallow base. And it breaks out just on monster volume. Looks like this one trades around 3 million per day. On that day, it traded close to 9 million. So it looks like about 3 times the average volume. And here's the aftermath here. You get a massive move, forms another base, gives you some more opportunities. And again, notice it's not perfect. Not every up week is on huge volume. But overall, anyone who looks at charts will tell you, the buying pressure is more prevalent in this stock than the selling pressure. Again, here's another view for you. This one, it really stands out. You can see, every 5 to 10 weeks, there's just some massive blue bars. Showing those skyscrapers of accumulation. Also notice on a different note, this is for a different webinar, but you get that relative strength line new high. That blue dot is telling us that the relative strength is hitting new highs prior to price. So we're, again, Ken Slim, we're not overly focused on one thing. We're trying to put the entire picture together, and it's not always going to be perfect, but the more things you can get in your favor, the better risk reward. So, if you have that relative strength line hitting new high, you have those massive earnings, massive volume, your odds are going to be drastically increased. So, you get that framework as a Ken Slim investor, and then you really want to drill down, and you're going to, as you trade more, as you watch more of these webinars, you're going to be able to hone in a little bit more and pay more attention to little details like that relative strength line new high. Okay. Just answer a few more questions here. What about the trend of volume? If the supply red bars are trending lower while the price is dropping or going sideways, is that a sign the stock is more susceptible to a breakout to the upside? Yes, exactly. So, Alan, when we're seeing a cup with handle, for example, in that handle, we're looking for the price to drift lower. It's just digesting the right side of that cup. And in an ideal world, that volume will dry up in the handle. And then once it breaks out, that volume will come back in. So stocks, they tend to stair step. We want to see a move up on heavy volume in a perfect world, and then digest sideways or slightly down on lower volume. Does that always happen? No, but more times than not, the leading stocks will move in that direction towards, moving up, trending with volume, and then hopefully pulling back on lower volume. Lisa asks, stock broke out and closed above the 5% pivot. Would you wait for it to pull back to buy or give up on it? So if I miss the stock, I'm never going to chase it. I like to, really be Johnny on the spot with these breakouts. If I miss something, I let it go. Now, if it pulls back into the pivot zone and it pulls back, it's pulls back in low volume, the market is still intact, yeah, by all means, give it a shot, but never chase outside of that 5% pivot. There's always another trade, always another opportunity, so we just want to move on. Remember, all investing is risk reward played out over a series of trades. It's nothing more than that. Joe wants me to repeat the amount of liquidity I look for. Again, Joe, this is just for me personally. Generally, I trade stocks that trade 500,000 shares or more per day. Generally, I gravitate towards higher price stocks. The reason for that, institutions gravitate towards higher price stocks. So I know it's counterintuitive, but in the stock market, just like outside of the stock market, you get what you pay for. But again, find what works for you. The way you're going to find what works for you is by maintaining a trade journal and doing that post-analysis. And again, I'm pointing out on this chart those skyscrapers of accumulation. You can see you get a nice move out of this stock right here. Here's another cup with handle base. And again, I'm just trying to give you guys a little bit of variety, but the concept is pretty simple. Stock breaks out, you get that massive volume punch, and that is the critical point. I'm just going to get moving here to selling because we're going a little bit over. And, the same thing goes for the downside. So on the downside, what we're looking for is the critical point, I would say, for our purposes as growth investors. The way we define the primary trend is that 10-week moving average. So if you start to see it drop through that 10-week moving average on massive volume, like you see this one, we want to get out, and we want to get out fast. Now, this stock, I don't see why you would be in it because it's not in an uptrend. But even if you were, you're getting out as it even breaks that 200-day moving average, which is a little bit of a longer term moving average. So both of those, that's a massive red light for us. And again, you could see up here, we might have been in this stock and in this first red bar that I'm showing. But again, it breaks through that 10-week, massive volume comes in, so we're getting out of the stock. Just showing you some more examples here. And you can see a lot of times when they break that 10-week moving average, heavy volume comes in, skyscrapers to the downside, it will lead to more downside in the stock. And we want to pay attention to this because remember, it's not enough to buy right. Buying right is the easy part. What I found, it's managing the position. So, we want to take a lot of our gains at 20%. And then if we're riding these stocks, we're defensive selling if it's breaking below that 10-week moving average on massive volume. That's our defensive signal to get out. Okay, here's a failed breakout. So this one looks like it tried to break out of a cup with handle. Not the prettiest chart pattern, but reverses massively. And you are definitely getting out there because especially it failed to break out of this base and get any follow through. And it reversed pretty harshly there with some massive volume. And you could see these volume patterns look completely different than those other stocks we were looking at. You can see these ones are dominated by those large pink bars as opposed to those large blue bars. Here's another great example. You're in a trending stock, starts to break through that 10-week. Now, you don't have to wait till the end of the week if you really see that volume coming in and it's decisively going through. This looks like it might have been on earnings, but again, we're showing you massive volume coming in. And that balloon signifies that it's the largest volume since that last base. Some more examples for you guys here. Stocks trending, breaks below that 10-week. That's the critical point for the downside, and we're looking to exit the stock right there. So screening for stocks moving on volume. The best one, in my opinion, is by going to the Stock Ideas button and going to the Up on Volume screen. So those are going to give you your stocks that are moving up on volume for that particular day. So you want to look at those. They're not necessarily breaking out or anything like that. So, if you want to look at stocks that are breaking out, just go to the breaking out today, and you can check if that volume is coming in on those. But one of my favorites, just purely on volume, is this Up on Volume screen. That's one of our more popular screens through IBD. Down on volume, this is your screener panel. Under MarketSmith stock screens, you could look at down on volume. I really don't go through these much. I mean, if my stock is down on volume, I'm going to know it. And then I'm not looking to buy anything down on volume. But we do have that option if you want to peruse through those. Personally, I don't use it too much, but that's where that one is. And then these are some other ones. So breakaway gap. We're looking for massive volume coming in on a breakaway gap. One of the more powerful setups. More times than not, massive volume will come in on these breakaway gaps, these earnings gaps. But remember to left click on the chart so that yellow data box appears, and you can see the volume percentage change through there. Putting it into practice. So again, we're looking for abnormal volume. We're combining both price and volume. In my opinion, the most important things in the market to pay attention to are price and volume. Earnings, the market itself, that gives us an extra edge. But first and foremost, like a doctor looking at an x-ray, our way of doing an x-ray is looking at the price and volume patterns in these stocks. That's telling you, what the stock is doing. It's good to know the why and everything like that because it's going to give us more conviction. But the most important thing is, what is this stock doing right now? Run up on volume screens for new ideas. So again, I don't think you have to get too crazy with your screening. Go through your normal screens, breaking out today, near pivot, up on volume, and just start to pay more attention to these volume patterns that I'm mentioning today. And then the gap up report for more ideas. For gap ups, I would say that's a little bit more advanced. So be careful with those. Those stocks can be a little bit more volatile on those gap ups. So just something to keep in mind. And let's see if we have any more questions for me here before I wrap up. I think I answered pretty much all of them. So I'll wrap things up here. We are going over a little bit. And as always, if you guys have any questions, feel free to reach out to us. Our number here at MarketSmith, our direct line is 800-424-9033. Feel free to reach us on our email, and look forward to hearing from you guys. Thank you.